Have you ever wondered how a legendary investor like Warren Buffett would look at a modern tech company? Well, today, that's exactly what we're going to do. We're putting on our detective hats and diving deep into one specific company, the digital consulting giant, Globant, all through the eyes of the Oracle of Omaha himself. And our entire investigation really boils down to one simple but super powerful question. Would Warren Buffett actually buy this stock? Right now, today. That single question is going to be our North Star as we dig into what's really going on with this company. So why Globant? What's so special about it? Well, it's because it's a classic investor's puzzle. You've got what looks like a really high-quality business that's just hit a massive speed bump. I mean, growth has slowed way down, the stock has taken a beating, and that leaves us with the million-dollar question, right? Is this just a temporary dip, a golden opportunity to buy a great company on sale, or is this a sign of something more permanent? Okay, so to solve this puzzle, we're not just gonna guess. No way. We're gonna pull out the big guns, Warren Buffett's own legendary 4-part checklist. This is the exact framework he uses to size up pretty much any company he's thinking about buying. All right, so here they are, the 4 big tests. First up, the business itself. Is it simple? Can you understand it? And does it have what Buffett famously calls a moat, a durable competitive advantage? Second, we look at management. Are the people in charge honest, smart, and do they think like owners, not just hired hands? Third, we got to check the financials. Does the company have a track record of being consistently profitable? And last but not least, the market test. Is the price you're being asked to pay actually sensible? And here's the kicker. A company has to pass all 4 of these tests to even get on Buffett's radar.
All right, let's get to it. Time to start grading Globant. We're going to kick things off with those first 2 tests, the quality of the business itself and the character of the folks running the company.
And right off the bat, Globant aces the first part. The business model? It's a definite pass. It's basically a service company. You can think of it like a toll bridge for the digital world, which is pretty easy to wrap your head around. Now, its operating history? That's a pass too, but with a big asterisk next to it. See, this company has an incredible history of growing at more than 20% a year, but right now, it's in the middle of a serious storm, and that growth has slammed on the brakes, slowing to just 4%. As for its moat, its competitive advantage, we'll call it narrow. It's got some decent defenses like high switching costs for its clients, but it's not the giant, impenetrable fortress that Buffett really loves to see. Okay, so what about the people in the driver's seat, the management? Well, here, Globant continues to look really good. It's founder-led, which is something Buffett absolutely loves. You get that owner's eye view. So that's a clear pass. They also get a pass for being candid and honest. I mean, they've been really open about the challenging macro environment they're facing. The only mixed grade here is on whether they just copy what everyone else is doing. They kind of do sometimes, but they've also been true innovators in the past. So far, it's so good, right? Globant is looking like a pretty solid company. But now we get to the numbers, the financials. And this, my friends, is where our investigation takes a very sharp turn. Because there is one specific metric, one single number that just might change everything. It could be a total deal breaker. So what is it? What's this one number that's so important to Warren Buffett that it could make him walk away, even from a business he likes with management he trusts? Here it is, return on equity. You'll hear it called ROE. And all it really measures is how much profit a company squeezes out for every single dollar that shareholders have put into it. For Buffett, this is like the ultimate litmus test. It's the key indicator of a truly high-quality business. It tells him, hey, how good is this company at turning my money into more money? And this is where the problem becomes crystal clear. See, Buffett has a benchmark. He wants to see companies that are consistently cranking out an ROE of over 15%. Now, Globant's 5-year average, it was already under that at about 9.3%. But today, right now, it has plummeted to just 5%. I mean, that is a massive gap. For a strict Buffett follower, that's not just a red flag. It's a giant waving stop right there kind of flag. So here's the bottom line on this. The business itself looks good. The management looks solid, but its current profitability, that all-important ROE, is just way too low to pass Buffett's tough financial standards. It's like the car looks great, but the engine just isn't running very efficiently right now. Okay, this brings us to our final test, the price tag. And this is where we run into a really fascinating paradox. On one hand, the stock looks incredibly cheap compared to its own history, but on the other hand, as we just saw, The actual business, its core profitability, looks pretty weak. Now take a look at these numbers because they tell a really interesting story. The top two lines, PE and price to sales, those are just fancy ways of measuring how expensive the stock is. And you can see the stock is trading at a massive discount. We're talking 50, even 70% cheaper than its own average. It looks like it's on a clearance sale. But then you look at that bottom line. The return on equity is down almost 50%. See what's happening? The drop in the stock price almost perfectly mirrors the drop in the business's quality. Let's just focus on that PE ratio for a second. A 56% drop from its average. That is just dramatic. It tells you exactly how much negativity is baked into the stock price right now. The market has gone from absolutely loving this company to being, well, deeply, deeply skeptical about its future. And this all circles back to one of Buffett's most famous sayings, price is what you pay, value is what you get. The price of Globant is definitely cheap compared to where it used to be, but the value you're getting, the actual profitability of the business, has fallen right along with it. That cheap price isn't a mistake or a gift from the market. It's a reflection of reality. So, the billion-dollar question is, can that value come back? Can the business recover? Now, before we give our final verdict, let's play devil's advocate for a minute. We have to be honest and look at the other side. What are the big risks that could stop Globant from ever getting back to its glory days? Well, there are really three big ones to think about. First, what I'd call the AI paradox. You see, AI is a huge opportunity for them, for sure, but it also makes the work they do, like coding, way more efficient. And since they get paid by the hour for their people's time, more efficiency could actually mean less revenue. It's a weird double-edged sword. Second, you've got rising wages. A lot of their developers are in Latin America, and if salaries there start to climb, it could really eat into their profits. And finally, there's the risk that their services just become a commodity. As digital transformation becomes something everyone does, it might just become a standard low-profit business. Okay, we've run the numbers. We've gone through all 4 tests. We've seen the good, we've seen the bad, and we've definitely seen the risky. It's time to answer that one big question we started with. So, would Warren Buffett buy this stock? For the man himself, the verdict is almost certainly no. Or maybe more accurately, it's a wait and see. Look, he'd probably admire the business. He'd like the management. But that rock-bottom return on equity, that's a deal breaker. He's the kind of guy who would happily sit on the sidelines and wait for clear, undeniable proof that the business is back on track before he'd even think about putting a dollar in. But wait, here's the final twist. While it's a clear no for a super conservative investor like Buffett, what our investigation really does is highlight a fascinating dilemma for everyone else. On one side, you have the Buffett case. Wait, the ROE is too low, growth has stalled, the quality just isn't there right now. But on the other side, you have what you might call the enterprising case. Buy. The stock is historically cheap, the business still has a moat, and it doesn't have a lot of debt. It's the ultimate showdown between today's problems and tomorrow's potential. And so that leaves us with the one question that every investor looking at this has to answer for themselves. When you look at Globant right now, what do you really see? Do you see a great business that's just going through a tough time, a temporary bargain? Or do you see a pretty average business whose best days are already in the rearview mirror? How you answer that single question, well,